Hello, dividend growth stock investors. So I have the first ever viewer requested video that I'm doing here. Had a viewer email me at dgicrab.com and asked what the advantages are to the strategy that I utilized and simply investing in the S&P 500 or SPY. So I thought that that was a very good question, and I want to break down to you why I am confident in my personal strategy, why I utilize it and invest in the way that I do versus simply dollar cost averaging into the S&P 500, which I do think is a fairly good way to invest if you just want to passively put your money into something each and every month and not have to keep track of individual companies or worry about different types of strategies. You just basically ride the market. That works for a lot of people that want to be passive about it. It's so much better than not investing at all. But I do believe that over the long haul, my strategy works a bit better than that. And I would like to go into that and explain to you why. Now, I will say to my viewer, requester, and everyone else watching, I'm not a licensed professional. So the opinions expressed in this video are just this one crab's opinion. And you should always do your own due diligence before investing in any ETF or any individual stock. Yeah, you should listen to this guy's ideas are crazy and dangerous. Oh, it's Dave Ramsey. Well, listen, Dave, I want to talk about why I like to do this strategy that I've come up here for myself. So let's close out of this guy here and take a look at our S&P 500. So this is SPY. This is probably the most famous and certainly longest standing S&P 500 ETF. Now, I personally utilize VOO, the Vanguard version of this particular fund. It just has a lower expense ratio. That's the primary reason why. There's some other ones as well, but S&P 500 is just going to have the 500 largest companies by market cap in the United States that also meet some other possible scenarios. That's not just market cap. But I'm not going to go into that. It's basically 500 biggest companies. Let's just leave it at that. And the S&P 500, since its inception more than a century ago, has averaged over the long haul 11% a year in price appreciation. When people talk about trying to beat the market, this is the market they are talking about that they're trying to beat. So again, as I said, if you just want to invest passively, just pick one thing, put your money in it, and not worry about it, S&P 500. I mean, it's the way to go because you're getting a piece of the 500 best companies, more or less, in the United States. And if you're not trying to pay attention to a lot of individual movers and shakers in the market, you're not a nerd like me with a spreadsheet trying to find value. Great strategy here. So I'm a dividend growth investor, though. The biggest downfall of the S&P 500 to me is, as far as dividend payouts go, this is the worst thing that I invest in. We're talking about a dividend yield that's generally in the 1.2 to maybe 1.6% range recently. And a lot of the reason is that the biggest companies in here, like Microsoft, Apple, Nvidia, those are companies that pay a small dividend and they make up a large portion of this. Then you've got Meta, you've got Google, you've got Berkshire Hathaway as companies that either don't pay a dividend or haven't until recently, and it's very small. So just a big portion of the S&P 500 are either companies that don't pay a dividend or the dividend they pay are pretty small. And then on top of that, the annual growth rate on the dividend yield is pretty pedestrian. I mean, it's generally, I think you can count on maybe a little bit closer to 6%-ish a year on the 5-year growth rate for the S&P 500, but it just hasn't been particularly strong over the years because it's not a dividend focused fund. It's a size of your market cap fund. That's the main thing that it's looking at. So I invest in it because I am getting some price appreciation, and I do want, even as a dividend growth investor, I do want to have some exposure to those rapid growth companies that don't pay a dividend. Like Tesla is a good example of that, or Amazon is another great example. But until they start paying a dividend and build up some history, I'm a passive income investor, so I'm just not putting my money in those individual companies for that primary reason. So let's talk about the construction of the S&P 500 and what's in there. I'm going to hop over here. This is stockanalysis.com. I'm going to use their list here of the 500 stocks in the S&P 500 because their website doesn't have a bunch of pop-ups and trash all over the place on it. Thanks, stockanalysis.com. Man, there were some bad ones that I had to sort through before I found this one. So if we look at the companies that are within the S&P 500, as I said, you've got your Microsofts, your Apples, your Nvidias. But let's talk about what's in the S&P 500 versus the 60 individual high-quality dividend growth stocks that I have selected to focus in on for this channel. Of those 60 stocks, how many of those 60 stocks are in the S&P 500? And the answer to that question is 56. So here's the stock list here that I keep on my spreadsheet of all of the stocks that I've got here for the channel. I've sorted it reverse order by market cap. So American States Water, not in the S&P 500, but they made the list because they have the longest consecutive streak of years of dividend increases of every stock out there at 68. And they usually increase that dividend by about 8 to 9% a year. You've got the two biggest BDCs. Well, let me clarify. You've got Main Street Capital, which is the largest internally managed BDC, and Ares Corporation, the largest externally managed BDC. I think these are the two best BDCs that are out there that you can buy. And then you have NNN, which is a REIT that didn't quite make it into the S&P 500, but this REIT has the third largest or third longest dividend increase streak history among all REITs. It's extremely consistent. So there's a very good reason why these four stocks made the list for me. And the other 56 are all stocks in the S&P 500. So, with my strategy, I recommend, and don't do it because I told you, this is just what I do, but I think it's a great idea that when you're investing, you put at least 50% of your money into ETFs. So that way you have automatic diversification in your portfolio. And as you're picking individual single stocks that are undervalued, and on my metrics, an undervalued stock from my list is a stock that is at minimum 20%, yielding at minimum 20% higher today than the 4-year average yield, and ideally 30% higher is when I want to invest in one of those individual companies. So the thought process is that you have a certain percentage of your money that's just going into the S&P 500. So that way we're sort of anchoring our portfolio, or let me put it in this term, my portfolio. I'm anchoring my portfolio to the market, being the S&P 500. So I'm getting the exposure to the growth and the price appreciation that I'll be missing out on if I'm not investing in any of these non-dividend paying stocks. And then I'm supplementing, or what I believe I'm doing is amplifying my price appreciation potential by picking the individual stocks in the S&P 500 that pay a dividend, that have a long dividend increase history, that have a wide moat, that are trading at very low prices. So for example, on the date of the recording of this video, Nike has just absolutely tanked in stock price. So Nike and its exposure in the S&P 500 is one of the stocks right now that's weighting the S&P 500 down. But if I am loading up on Nike while it's down, then theoretically I have a much larger potential of price appreciation by adding to it while it's taking an absolute beating, as opposed to buying it when it's going through a hot streak and it's trading higher than maybe it should be. So, and this goes for any of the individual stocks here in the S&P 500. If they're weighting down the S&P 500, I'm actually aggressively going in and adding them because I think the share price appreciation potential is a lot higher, and it's giving me a better dividend with a higher starting yield and a much better year-to-year annual growth streak or growth rate than the S&P 500 is going to offer. So what I'm hoping to accomplish is a best of both worlds scenario, and we'll see. I mean, I haven't been at this for 100 years. I don't have a 100-year history of 11% price appreciation. But what I'm hoping to accomplish, what my overall goal is that if I'm correct more often than not, utilizing my metrics based around the 4-year average yield, my portfolio or my cluster of individual stocks, let's just say, will have a better than 11% price appreciation over the long haul because I'm only buying the quality stocks when they're at very low marks and just leaving the ones alone that are trading really high. But I'm still getting the growth with the exposure to the S&P 500 that I'm getting by just dollar cost averaging into it. I want my portfolio to have the dividend increases year over year collectively of about 12% on average. That's based on my age. And I want the price appreciation of the portfolio to be even higher than that. Hopefully more in the 15 to 16% range. That's a fairly lofty goal, but if we are buying single stocks and ETFs, I'm pretty convinced that this is the safest way to attempt to beat the market. It may not work, and in some years I'll beat the market. Some years the market's going to beat me. There's nobody out there that's going to beat the market every single year 100% of the time. But my goal is to beat the market more often than not, but also do it in a way where I'm not just rolling the dice on maybe smaller cap companies that could shoot up into the moon, but could also crater back down. I'm not a big fan of gambling with my investments. I want to be able to sleep well at night by buying stable companies when they're on sale. And just as we'll just take a quick look here at just some of the ones at the very top. My 60 growth stocks include Microsoft here at number 2, Broadcom's in there, JP Morgan, Exxon, United Health, Visa, Procter Gamble, Johnson & Johnson, Home Depot, AbbVie's in there, Chevron, Coca-Cola, Pepsi, let's see here, Texas Instruments, McDonald's. So a lot of the stocks, not only in the S&P 500, but even the ones in the S&P 100, if we could call it that, are part of the DGI Crab 60 stocks that I cover here on the channel. So I'll get the exposure to them when they're on a run because I'm dollar cost averaging into an ETF like this, as well as some other dividend focused ETFs like VIG, SCHD, VYM. But also I'm going to pick out the bargains individually where I think that I've identified said bargains. So hopefully that answers your question to the person who sent it in, and I appreciate it. And if you have any questions you'd like me to answer in video format, email them to me, dgicrab@yahoo.com. Check links in the description below to the 4 tiers where I go over all the 60 stocks I picked for the channel. And I'll see you next time. Who do you think will win, SPY or DGI? I know my answer.